All right, back at it. Let's dive into some accounting concepts. All right, so the first thing we want to look at is something called the accounting equation. And understand that any business is going to have three different things. It's going to have assets, it's going to have liabilities, and it's going to have, hopefully, positive equity. Okay? Now, assets are made up of certain categories of accounts. So, things such as cash, things such as accounts receivable, things such as inventory, are going to be, and property, plant, and equipment are going to be assets. Liabilities are claims against those assets by outsiders, third parties, such things as accounts payable, taxes payable, wages payable, so on and so forth, notes payable. And the equity is the difference between the amount of assets you have minus the liabilities. Notice you've got an equal sign here, right, between assets and the liabilities plus equity. And so at any point in time, the sum of your assets has to be the same as the sum of your liabilities plus owners or shareholders' equity. It's always got to be in balance. You can never have it out of balance. If you have it out of balance, something is wrong. Now note here what makes up equity. Well, equity has several different components. One is, for a corporation at least, common stock. When a shareholder invests in a company, they buy common stock. And so that becomes a part of the equity. Why a shareholder would buy stock is because they want to not only have the stock value appreciate, but they also want to share in some of the earnings of the company as the money's earned. And so those would be called dividends. And so if dividends are paid by the company, that would reduce equity, whereas common stock, the investment in common stock, would increase owner's equity. Two other things either increase or decrease owner's equity. Revenues increase something called retained earnings, thus owner's equity. And expenses decrease owner's equity. All right. So bottom line is, you can break this up a couple of different ways. Equity is made up of contributed capital plus retained earnings. Contributed capital is the purchase of stock. Well, what's the retained earnings? Well, it's past earnings of the company that have not been paid out in dividends. They're retained by the company. And so how do you get retained earnings? Well, when revenues for a certain period are more than expenses for that period, then you have net income, and any net income that's not paid out in dividends to shareholders becomes retained earnings. All right, so let's do some of this stuff. So it says use the accounting equation to compute the missing financial statement amounts. So first one, Bose, gives us the assets and gives us the liabilities, but doesn't give us the equity. And based upon my earlier statement, you know that at any point in time, the amount of assets has to be the same as the amount of liabilities plus equity. You would know that for this instance, it's got to be the difference between 150 and 30, so that's going to be 120. For Vogue, you have liabilities plus equity but no assets, but since you have an equal sign there, obviously, you would know that assets have to equal liabilities plus owner's equity, so that's going to be 400 in assets. Here we have an expanded accounting equation to compute the missing financial statement amounts. So here assets equals liabilities plus equity, and the equity is made up of this, 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 and this. So you've got common stock of 100, no dividends. So what must revenues be in this case? Well, revenues must be 20, or excuse me, 60, because you need to come up with an additional 20 in equity, since you have here 100 in common stock. You've got to come up with net income of 20, which is the difference between revenues of 60 and expenses of 40. YouTube. Assets equals 400, liability 160 plus 240 equity. And so here you have common stock of 220, revenues of 120 minus 90, so you've got what, 220 and 30. So 220 plus 30 would be 250. So dividends has to be how much? 10? Yep. Because that's going to get you to 240. All right, let's analyze some business transaction using the accounting equation. So transaction 1, this guy Chaz, or I think that's Charles Taylor, invests $30,000 cash to start a company. What accounts are involved? Remember, accounts make up assets, liabilities, and owner's equity. Put another way, there are different types of accounts that make up assets, different accounts that make up liabilities, different accounts that make up owner's equity. Here we have 30,000 cash. So we have that going to cash, the cash account. What's the 30,000 going to go to? And understand, you always have when you have a transaction that affects the accounting equation like this, that's part of analyzing the situation, asking yourself, does this transaction affect the accounting equation? does this business activity affect the accounting equation? And, pretty soon this becomes fairly automatic that you can figure this out pretty easily, right? That $30,000 cash being invested in a company changes the accounting equation. But let's say a different business activity. Let's say you have a new sales manager who starts with the company and he signs a contract agreeing that he'll work for the company and that he'll be paid $200,000 per year. Well, him signing that contract is certainly a business activity, but it doesn't change anything in the accounting equation, at least not yet, not till you pay him. So not all business activity affects the accounting equation, I guess is what I'm trying to say. But here, obviously, it does. And understand when you have a business activity that affects the accounting equation, it's going to affect at least two accounts, maybe more, but many times just exactly two accounts. Now, that doesn't mean that it affects both sides of the accounting equation, as we'll see here as well. I'll tune you into that as it happens. But here, you have $30,000 in cash going to assets. The other $30,000 account affected is owner's equity, or if there's stock involved, common stock, which affects equity. So both go up in this case, $30,000. All right, so after this transaction, we look at our accounting equation. You've got $30,000 on the left. Under assets, you got $30,000 on the right under equity. So our accounting equation is in balance after this transaction. Transaction 2, company purchased supplies paying $2,500 of cash. Now, what accounts are affected here? Tricky. Here, you have two accounts, both of which are asset accounts. You're exchanging one asset for another. You're exchanging $2,500 of cash for $2,500 worth of supplies. So you're just simply changing the substance of your assets. And so note here, one asset account goes down, cash. Another is created and goes up, supplies. So after this, we have two transactions. Note, overall, nothing's changed as far as the bottom line assets versus liabilities. We simply exchange one asset, cash, for another, supplies. Transaction 3, we purchase equipment for $26,000 cash. Same deal. Cash goes down $26,000. Equipment asset account goes up $26,000. Again, the bottom line numbers concerning assets and liabilities plus equity, $30,000 on both sides, remains the same. Transaction 4, we purchase supplies of $7,100 on credit. Okay, so what are the accounts involved here? Well, we're adding $7,100 to our supply asset account. What's the other account that's affected here? Well, it's going to be something called accounts payable because we're purchasing this on credit and it's going to be paid sometime later. And recall that under the matching principle or the expense recognition principle, we recognize an expense when it's incurred, not when it's paid. And so we're going to open up an account, a liability account called accounts payable, and it's going to increase accounts payable by $7,100. It's going to increase our supply account by $7,100. Note here, both sides of the equation have gone up by to 37,100 or increased by $7,100. Why? Because we didn't pay cash. Our assets, we increased assets. We also increased liabilities. There was no corresponding decrease in assets like there was with a cash purchase in 2 and 3. All right, so let's look at some transactions involving revenues, expenses, and dividends. Transaction 5. Provided consulting services to a customer and received $4,200 cash right away. That's a nice feeling. What accounts are involved here? Well, cash. What about the other? Well, that's going to be probably consulting revenue or consulting service revenue or something like that. Again, what you call something, there's no certain correct way as long as the business knows what it's talking about and it's not too far afield from standard procedure in the industry. So both go up by $4,200, and so now your assets as well as your liabilities plus equity have increased $4,200 on both sides. 6 and 7. We pay rent of $1,000 and salary of $700 to employees. Okay, so the rent is going to be what accounts are affected? Well, we're paying, so that means cash is effective or affected. And the other part of this is going to be a rent expense, which is going to reduce equity. So you reduce cash by $1,000, you reduce equity by $1,000. Same goes for salaries. You reduce cash by $700, and you have a salary or wage expense of $700. That's going to be an expense, obviously, and so it's going to reduce equity by $700. So notice both sides have gone down by $1,700. Transaction 8, provided consulting services of $1,600, and you rent facilities to a customer for $300 on credit. So you're not getting the $300 right then and there. Notice the $1,600, the consulting services, is also for credit. And so again, the accrual method of accounting and the recognition principle commands us to recognize the revenue when we earn it. Well, we earn it here. So we're going to recognize revenue of $1,600 on the consulting services and on rental revenue, I guess, is what we would call that. And then the other side of this, the affected accounts are going to be accounts receivable, consulting services or something like that, and then rent receivable, I guess. So they put both the consulting revenue receivable and the rental receivable under accounts receivable. So you have 3 accounts affected. So let's look at that. Okay, transaction 9, client in transaction 8 pays $1,900 for the consulting services, so cash goes up $1,900, and you reduce accounts receivable by $1,900, so that goes down. Transaction 10, Fast Forward pays $900 as partial payment for supplies purchased in transaction 4. So accounts payable gets reduced and cash gets reduced. Transaction 11, dividends of $200 are paid to shareholders. So what accounts are affected here? Well, dividend expense and cash. So dividend expense is going to go up and cash is going to go down. And note, even though dividend expense is going up, it reduces equity. Remember, dividends cause the equity to go down. So an increase in a dividend account is a decrease in equity. I know that's kind of, in some ways, counterintuitive, and you know, that's the thing about accounting. Sometimes, you know, until you get used to it, you kind of have to just follow the rules. And I don't know, I think it somehow your brain changes as you get used to some of this stuff. I'll let you look at that. We're skipping over that. All right, after you get through over a certain period of time, monthly, quarterly, yearly, you're going to prepare basic financial statements. And there are 4 of them, and you prepare them in the following order. You prepare the income statement, and with the income statement, you record your income less expenses equals net income. The next statement that's prepared is called the Statement of Shareholders or Owner's Equity. might be called statement of retained earnings as it is in the book. And then third, you're going to prepare something called a balance sheet, which simply lists your assets by accounts plus totals, lists your liabilities and your owner's equity. And then last but not least, there's another statement called the statement of cash flows, which simply lists the incoming and outgoing cash for the period. So let's look at that. All right, so here we've got this company Fast Forward. We had consulting revenue of $5,800, which is the $4,200 plus the $1,600. We had rental revenue of $300, so total revenues is $6,100. We had two expenses, the rent expense and the salary expense. And so we just carried the total expenses to the side here as it does in this statement. And so total expenses minus total revenues minus total expenses equals net income of $4,400. All right. Now this is a brand new company, so there's no retained earnings. Remember, retained earnings is all earnings from prior periods. Well, we just started this company, so there isn't any. So retained earnings is 0. To that we add our net income of $4,400, and we reduce shareholders' equity or retained earnings by the dividend amount, which is $200. So retained earnings at the end of the period, which is 1 month in this case, is $4,200. Well, now that we have retained earnings, we can prepare our balance sheet. And so here on this side, we have our assets, cash, $4,800, supplies, $9,600, and equipment, $26,000. Total assets of $40,400. Over here, we have liabilities of $6,200. That's our only liability. And then equity, we have our common stock of $30,000. We have our retained earnings of $4,200. So total equity is $34,200. If we add that to the total liabilities of $6,200, we also get $40,400 on the right side of this equation. Now note, it's common to, and you can do this a couple of different ways, this balance sheet. You can have assets on top and then right below it liabilities and owner's equity, or you can have it side to side. And if you have it side to side, as many do, you put assets on the left, just like your accounting equation, and you have liabilities on top on the right side, and then right below it you have your equity section. And then down below you have your cash flows. We'll talk about statement of cash flows at some later date. I'll let you look at these need to knows. All right, so that's it for chapter 1. I will put some assignments and a quiz out there for you on Connect, so make sure you understand what Connect is all about and become familiar with that.